Welcome, Jeff Porter. This is Jennifer Young, Utah Community Credit Union, host today for this construction loan webinar, teaching you a little bit about our construction loans. Glad you could join us. We're very cognizant of your time, so we're going to try and get through this as quick as we can. We're planning on stopping at the half-hour mark at 2:30. So anyway, we'll jump in with that and get things moving. Jennifer's just responding to somebody here real quick, so we'll get going. But we do have a couple of housekeeping things.
Yeah, we're just making sure, sorry, you know how technology is, just making sure that everybody is able to get into the webinar and access the information, but just a few housekeeping items. First thing, if you have questions, please make sure that you put it in the Q&A. We'll stop just maybe 1 or 2 times through the presentation and answer some questions. And at the very end, we'll answer a few more, but we want to make sure that we're covering all of the information. We try really hard to hold this to half an hour, so we'll respect your time, do a high-level flyover, and then come back and pick up questions along, that you've got.
So should we get right into it?
I think so.
Okay, great. So, when are you going to do a construction loan? That's probably one of the biggest questions that we run into. And one of the things that you love to talk about is, there are actually 2 different types of construction lending that go on. There's the big box builders that are out there, and when you go to them, they actually have just a few different plans that you can choose from. And you have to use those plans, and then you can pick a lot to where you're gonna build. That's not the type of construction loan that we're talking about. The construction loans that we're talking about here are you're finding the lot, you're buying that lot, and you're gonna build on that lot with a custom builder, or potentially, if you have experience in the industry, you could do it as an owner builder. The other thing that we're going to look to do to help you out with construction loans are on existing properties. So somebody that owns an existing property, we would actually, we could help them do a big remodel. So a lot of times you're talking about the remodel where, you want to bust out the back of the house or add on some attachment to the home or whatever. So anyway, those are big projects, but we do construction loans on those renovation existing home projects. So, anyways, there's something you wanted to add to that? I'm kind of jumping around a little bit.
No, you're good. We got a little bit scattered there at first. Sorry about that. We were a little bit scattered, making sure that people could get connected in. But we just wanted to make sure that you knew that there was a difference between purchasing from a big box builder. That's a good way to put it. From a developer that is going to be building your home. You don't have to worry about the construction loan. This kind of construction loan that we're talking about is when you're specifically going to be building or renovating, and you need to provide that course of construction. So again, that's kind of what it does. It just kind of reiterates when you can't find that perfect home and you're ready to go ahead and move up into a home that is going to maybe be your forever home or whatever, then this type of product, this construction loan, is the instrument that you'll need to use to accomplish that goal.
So we've got a couple different kinds of construction loans. We've got what's called a one-time close, 2-time close, and a renovation loan. And we're going to get into each one of these and talk about them a little bit. So let's talk about the one-time close here a little bit first, and then we'll move on from there. This one-time close construction loan, what that one time means is that we're closing both your construction loan and your long-term financing all at the same time. Now that's great because there's some big benefits for that. Number one, the biggest thing is you don't have to worry about paying 2 sets of closing costs. So that's really nice.
Really nice.
And on top of that, you're going to get to be able to lock in your long-term rate right up front, which is fantastic. So we love being able to do that. And when you lock in that long-term rate, a lot of people say, well, what happens at the end if the rates go down? Well, we actually have a float down option as well that you can float down and get that lower rate. So it protects you both ways.
Win-win.
Super win-win for everybody. You don't have to pay the closing costs twice, like we talked about there. And the term on these are 12 months, our construction loans. So what's going to happen is you need to have your property built within that 12-month period of time. And then we would convert you at that time to the long-term financing. All the construction loans during the course of construction, they're going to be interest-only payments. And so what that means is at the beginning, you're not going to have very much or very little on the balance of your construction loan. So let's say we give you a loan for $500,000 to build your home. We're not going to charge interest on the $500,000 because you haven't borrowed any very much of that yet.
Right.
Maybe you borrowed a little bit, and so you're going to have a very small interest-only payment to start with, whatever the balance is. And the more you draw on that, and the more you get on it, then that interest-only payment will increase until the end when we're ready to convert you to the long-term financing.
Right. And one of the other questions we've addressed that we get quite often is what happens if you don't finish the home within those 12 months? We are happy to work with you on extensions. We would like to know up front if you're going to be able to meet that. If not, there's always unforeseen things that happen. But maybe a builder comes to you and says, you know what, we're going to go ahead and do this, but it's going to take us 15 months to build the home. If we know that up front, then we're able to negotiate with our secondary marketing department and hold that rate for the 15 months. But if for some reason the builder comes to you and says it's going to take us 9 to 12 months tops, and they get through that time period, and we've counted on that 12 months, and then you go longer than that, we are not able to hold that rate. We're not able to hold that long-term rate. And so what happens if the home isn't completed? Then we'll extend the construction loan, but you will lose that long-term rate. You'll have to go to whatever current market is. So there is some risk there. And the biggest thing is communicating, letting us know
very much.
at the very front.
If we can know right away that there's going to be an issue, then we can have it in the file that's going to be something that we're going to have approved and ready to go. Otherwise, we could have some problems. But lot loans. This seems like an odd thing to come up in the middle of it, but it's really an important process in this. And the reason why is a lot of people say, well, why would I need to get a lot loan if I'm getting a construction loan? Well, that's a very good question. The problem is you can buy the lot if you're looking to buy a lot at the same time you're doing your construction loan. However, the seller may not want to wait.
Right.
A lot of times that seller will be like, well, I don't want to wait for you to get your plans done, to get your cost breakdown done, and your
Permits
bids,
through the city.
permits the city. I mean, all of this can take months and months, maybe 5-6 months. And so a seller typically doesn't want to wait that long, and they'd rather just sell the lot to somebody else. So we have a lot loan to be able to get you that lot loan. And then once you're in the lot loan and your construction loan is ready, then the first draw of the construction loan will be to pay off the lot loan. So you'll never have two loans. We'll just get rid of the lot loan. It'll go into the construction, and you wouldn't have to worry about that any longer. But for the lot loan, we're looking at improved building lots that have year-round access. We're going to go up to $500,000, and then we have 3 different loan programs that we can do with this. The 3-year balloon or a 5-year balloon, and those are amortized over 30 years to keep your payment low during the time that you have the lot loan, or a 12-year just fixed rate amortized loan. Now, because it's on 12 years, the payments are much higher. So you have to kind of look at those and what you're going to do. But going back to the 3 and the 5-year balloon, a lot of people are like, what do you mean by the balloon part? Well, what that means is at the end of either that 3-year or the 5-year term, whichever one you chose, we would either have to have it paid off or we'd have to refinance it.
Yeah, roll it over into
roll it into another loan. The purpose of this lot loan is never to be a long-term loan. The purpose is we know that you eventually want to build on this lot. So therefore,
it's just an instrument
it's
to
gonna be
allow you to
short.
get ready. It gives you that time frame to where you've tied up the land and now you're able to work on your plans and specs and get ready for the construction. So
Right.
it's just a way to tie that up.
So, we'll go up to 80% loan to value on these, and whatever you're putting in, I've got the 20% that you're putting into this lot loan that will be credited and taken into account on your construction loan when we're doing a construction loan.
Right.
So be aware of that.
So we're going to jump into some of the specs a little bit more on the construction loans, just so that you know we do charge interest-only payments on the course construction, like Jeff alluded to. It's interest only on the funds as they are drawn. We offer a 12-month construction term. In some situations, we realize that we need to go longer because of the scope and the size of the project. That is something that we'll look at. It's not something that we just shy away from. We'll look at it, and depending on the scope, we'll set that term at what we think. We will go up to 95% on conforming loan amounts. So conforming loan amounts are anything $726,200 and lower. We will go up to 95% of value or cost, whichever is the most limiting. So keep in mind, a lot of times people will say, okay, we're going to build, the appraisal value is $800,000, but it's going to cost us $700,000. We're going to base our decision based off of whichever is lower of the two. So if that $700,000 is the lower of the costs, that's what we're going to use. Same on on the jumbo, we'll go up to 80% of the loan to value or loan to cost, whichever is most restrictive. We do require 10% contingency on all builds. We get a little bit of pushback on this from time to time.
So I have a question for you. What percent of borrowers use their contingency?
100%.
100% everyone. So it's a very important part of why we put that in there. What that contingency is meaning is that you go over on one of your categories that you got, priced out with the subcontractor, and they're saying,
blindsided.
Yeah, now it's come in for more. This contingency will cover you, so you don't have to worry about coming up with your own funds. And it gets used 100% of the time. There's not one deal that we've ever come across that isn't using it.
It's a safety net. It's a safety net for you in case you get blindsided by something that was totally unanticipated. Now, that being said, we're going to hold you to specific budgeted items. So if you set aside, and you're going to hear me refer to appliances a lot, but if you set aside a budget of $10,000 for appliances, and you go to pick out your appliances and you fall in love with a $10,000 fridge and you don't have enough for the rest of them, you're going to need to write a check for the difference. But that being said, this contingency is there in case there are emergencies that come up or overages that you just get blindsided by, and that's why we require
real nice protection for the borrower.
So,
and then we do allow people to do a home as an owner builder
with some caveat to it. We want to make sure that you have experience in the industry. It's not something, building a home is a lot. There are a lot of different steps, a lot of things involved, a lot of risks. It is the single biggest risk that lenders offer, construction financing.
Yes.
It is not a long-term loan. And so we want to make sure that that if you're going to do it as an owner builder, that you're in the industry, that you understand what you're doing, and that you've got the coverage that you need.
Right. And we do have some restrictions on our loan to value on those. We're going to have you come in with a little bit more, have more equity in what you're doing with that.
So more details. Your origination fee is 1% on all construction loans. We will go up to $2.5 million. That is not a cap. That is recommended, and we like to stay in that realm. If you do have a scenario where you need to go over that, we may keep it in our department. We may move it to the commercial department.
Right.
We just will look at that and depend on what scope it fits the best within. We do primary and secondary residences, which
that's pretty critical. Secondary, doing a second home, or some people call it a vacation home. And this area is something that happens. I mean, you've got the Sundance area, Provo Canyon, Heber, Camas. I mean, there's a lot of places in this area, semi-locally, that would be considered a second home. But we will do those.
Yep.
So, yeah.
Most people limit construction loans to primary residence, so secondary is a really great option. We also offer 1, 2, 3, and 4 plexes as long as one of the units is going to be a primary. And so if you're looking at, building something that is going to give you income for the other units, but yours is going to be but you're going to be in it as a primary residence, that is mandatory. If it's going to be all investment, and if it doesn't make sense. So if you're currently living in a, $500,000, $1 million home, I can't even say $500,000 anymore because that's almost a starter home. But
I know.
if you're living in a home and all of a sudden you want to build a fourplex and doesn't make sense, we may question that a little bit, and we really want to make sure that this is going to be a primary residence.
Right.
We always qualify you for the long-term financing, regardless of what term or program you choose. We will always qualify you. We do work with brokers that do the long-term takeout, and we provide the construction financing. And regardless of your relationship with the broker or whatever the situation is, we will always qualify you for the long-term takeout. It is really important for us to make sure that it's clear the construction financing is not long-term financing.
Well, and we want them to have a good exit strategy,
Yeah.
right? What are you going to do after construction? Is it okay? Are you going to be okay to get into that long-term financing? Because building the home is one thing, but you got to make sure you can pay for it at the end. So
yeah, you want to make sure you've got the long-term taken care
Yeah.
of. So more in the process.
Yeah. So there is a process in getting it. When we're talking about the construction loan itself, let's say we're past the lot loan stage here. And when you are, the first thing you're going to need to decide is, are you going to do this as an owner builder? Could you qualify for that? Or are you going to have a builder or a general contractor that is going to be taking care of this for you and helping you through that process? A builder or general contractor, we have a form, we're going to check some things on this. We're going to look at their history, what they've done, what are some of the projects they've worked on. We're also going to get a copy, their business license, their insurance to make sure they're protected in that regard, their workers' compensation waiver or insurance to protect them in that regard. And so we're going to really look at the builder, make sure that we're good with that, and know you've got a good builder on your hands as best as we can tell. And then we're of course going to ask you guys for documentation. We're going to want to get your personal income and asset information. We're going to check your credit. We're also going to get the plans and the cost to build from you from the builder. And we're going to also have you and the builder sign a contract between the two of you stating what's going to occur within the building process and how much it's going to be. That way everybody's on the same page and we're in a good spot there. So once we have that information, we're going to send that through our underwriting system, and we're going to get a preliminary approval, maybe have a couple of small conditions. And at that point, we're going to feel really comfortable. We're going to say, hey, your income looks good, the builder looks good, everything's looking good. Let's get that appraisal and title going. So we'll get the appraisal work, and then we'll contact a title company to pull the title history on the lot, make sure there isn't any other liens or judgments or anything on there that we weren't aware of. And once those items come back, we're going to get the final approval done.
So that brings up a really good question, or not maybe so much a question as making sure that that we're going to also work closely to check the SCR, the State Construction Registry. Utah is unique in the nation. No other state in the nation right now has a state construction registry. I think that's really interesting. And what that is a way to protect all parties involved in the transaction. And so that's why it's really important to vet the builder's information, make sure that the builder has a good standing with the State Construction Registry as well. And title helps us with that. Title works very closely with us to make sure that there are no prior liens, that there are no issues, and can ensure that first place position. So that's really important to know.
Definitely.
So once the final loan approval is issued, we're ready to go to closing, and you will be closing at the title company. We encourage you to not start prior to the closing of the construction loan, but
there are reasons why. There are reasons why we don't want you to do that. Now we will allow you to close even if you've started building. But let's give a scenario real quick. Let's say you get the foundation dug out and you get them to come in and pour your footings and foundation. when that happens, those subcontractors that came in and did that work are going to put their information in saying that their work is being done or has been done with the state construction registry. So that's basically like a pre-lien that is sitting there, and we can't close unless they remove that or give us a waiver. And if they, for some reason, refuse to do it, then we would not be able to close your loan. And so that's really important to take note that we could run into issues if you got too much work done and those subcontractors were not willing to play ball. And the reason why we can't do it is that their lien that they put in there will take precedence over our first mortgage, and we can't have that. We have to be in first mortgage position. And so we do allow it, and funny enough, we are the only ones that do allow it. And so, that I know of.
Yeah, we know of, unless you want to go with hard money loans.
Right.
Hard money loans don't.
Right.
They
So
don't care.
if for some reason we couldn't close your loan and you'd already started building, you wouldn't be able to get financing from anybody else. So it's just smarter if you can wait until you're completely done with your loan and it's closed before you start building. It's just a smarter way to go.
Yeah. So we handle all of the draws and inspections, our construction department. I love the fact that we can say we handle it all, because that's the benefits of membership with the credit union. Once the home is complete, that is when we get the completion, we get a final inspection, we get the certificate of occupancy from the city. Once we reach that phase, we are ready to go ahead and convert it over to the long-term financing. And that's when you'll sign, if you've done a one-time close, that's when you'll sign a modification. All it does is modify it from the construction loan to the long-term financing, and then you're off and running. Then you're off on your long-term payments, your regular, fully amortized payments. That's tongue-tied. Anyway, that's when that happens. And we like to cover some do's and don'ts before just so that we make sure that we've covered everything. There are some very simple do's and don'ts. The first thing is communicate.
Yes, yeah, definitely.
Really, really make sure that you stay in touch through the course of construction. Keep in touch with your builder, contact your loan officer, make sure that you're visiting the site often, make sure that you're if there's any questions along the way, if you have questions or concerns, make sure and bring those up as quickly as possible. The sooner that you can tell us, the sooner that you can communicate it with us, the more that we can help advocate for you.
Exactly.
So
couldn't say it better myself.
Some of the don'ts.
So don't begin construction before
if you can avoid it.
If you can avoid it. Don't incur any new debts or increase your current debt during construction. So don't go buy a car. Another trick that happens is you'll like, oh, I'm going to open this deal over at Home Depot, a line of credit. Well, we're going to see that you have a line of credit over there. And if you start buying stuff in advance, that could affect your debt to income ratio, which can affect how much you qualify for. So again, going back to the do's, communicate with your loan officer, let them know what it is that you're thinking about doing, and that can solve a lot of problems. And then the next one, change of your income or employment status can be a real huge factor in, and this might seem like a no-brainer, but we're in life, we know that a lot of things are going to come up, and maybe you've got a great opportunity to take on this new job. Well, from your perspective, it looks great, but from our perspective, maybe there's an issue. Like if you left a straight salary position and you went to a job that was salary now plus commissions, we may not be able to count those commissions, and maybe the commissions are a reason why you're going to be making more money than you were before. But because we can't count them, now that affects your ability to get approved. So communicate with your loan officer when these things come up, so that we can go over what's going on and if it makes sense and if it's going to be okay for your loan.
Likewise, the change of income or employment, we do have situations where that is just necessary. We've had scenarios where our members have lost employment through the course of construction, and not to panic. Our goal is to help you through this process and to make sure that you're able to get things wrapped up and close on your long-term or convert it over to the long-term financing. So sometimes changes are inevitable, and that is fine. The quicker that you can, again, just let us know, the quicker that you can let us know that we can advocate for you and we can help you through that.
Right.
So you really are never alone through this process. We are there with you literally every step and every point of the construction. So,
Absolutely. And the last one here, don't deviate from your plans and costs. Again, just sometimes the loan officer gets left out when you're having these great discussions with your builder of, hey, it would be better if we did this with the home instead of this. And then all of a sudden they get all these plans changed and oh my word, we have no idea. And that could affect, again, you know, if you took out a bathroom to make a room bigger, well, now it's one less bathroom and that would affect the value of the home. So things we need to be involved with and know what's going on.
I can't tell you how many times we get things like, well, while we're building, we should just go ahead and do this. While we're doing this, we should just go ahead and finish the basement or upgrade this or do this. And then before they know it, they're way over and they're kind of going, okay, wait, we spent how much? So.
Well, we've got some, we put together some questions of a lot of things that have been asked recently, but feel free to put any questions you have into the chat or Q&A, and we're happy to answer those for you. But we'll go through some of these questions to at least give you an idea of what's happening there. But can we do barn dominiums?
We can, if, I always have the caveat, if they are customary for the area. The biggest issue that we run into when we do something that is unique or different, like a barn dominium or a pole barn home or a prefab home, is are they customary for the area? And if the answer is yes, and the appraiser can find comparables for those properties, that is the biggest hurdle that we get over. So if they're customary and then we're able to work with them. If they are not, we may just take a pass on them.
So when does it make sense to take out a construction loan versus a HELOC for renovations? I really love this question.
So the biggest issue that we have here, number one, if it is a minor repair, if it's a minor update or renovation, so if you're going to go through and you're going to change doors and you're going to paint and you're going to do just kind of a refresh, then a HELOC is
Totally
probably a really good idea. If you're going to be changing the footprint of the home, if you're going to be changing walls, if you're going to be, like Jeff has mentioned, like blowing out the back end of the house, which, you know, if you've just simply outgrown your home, that might be necessary. If it's going to be major like that, you're going to want to have a construction loan in place. You're going to want to have a partner that's going to help you through the inspections and the disbursement of those funds and making sure that things are getting handled correctly. That's where we can really partner with you with a construction loan. Not only that, but your home equity line. The two biggest differences is a home equity line of credit is going to evaluate your home based on the current condition.
What it is right now.
It is not going to take what the home is going to be.
And the construction loan does that.
And the construction loan does that.
Yeah.
The construction loan looks at it and says, what is that future value going to be? And so just keep that in mind when you're looking at, especially for the renovation, if you're going to be doing major, it may be worth the effort to go ahead and do a construction loan. So.
Yep.
Okay, down payment requirements, what's required? I think we covered that.
Yeah, we covered that. Just a real little recap. We'll go 95% to those conventional loan limits of $726,200. Above that loan amount is going to be a jumbo loan, so we'd be limited to 80% loan to value. And then if you're going to be an owner builder, you could be at 80% loan to value.
Correct.
Can we qualify for construction loan if we currently have a HELOC already?
Yes. So we require that we're in a first place position. So if we're doing a renovation and you have a first mortgage and you have a HELOC in place, we will be stepping in and paying off that first and paying off that HELOC and taking a first place position. And so you can see that on a renovation, we're going to be advancing a lot more at the very front end of the construction loan. And we realize that, we recognize that, but we require to be in a first place position. So regardless if you're a first or a second, if you have a first and a HELOC, it doesn't matter. We'll take a first place position.
So what if we don't want to move out before we finish building the home? Do we have options? And we haven't hit this one yet. So yes, This is great. We do what's called a cross collateralization. So what we're going to do is take the equity that you have in your current home and use that to help you qualify for the new construction loan on the new house. And basically what we're doing is we're putting a lien on both properties to be able to use that equity. So then when you sell your current home, that lien's released obviously because you're selling it, and then the proceeds from that can go down on your construction loan and bring down the balance on that. So it's a nice way to make to not have to move out of your current home and be able to get into this new custom build that you're doing.
And that is, I'll just add to that, that is unique with the credit union because we have the option with our portfolio deals to be able to utilize that option. That is not something that is customary in the market.
No, it's
to
not.
take two properties and cross collateralize and do all of those things. That is unique. So.
And then last question here, can we get reimbursed for items paid for in advance?
You can. So
Yeah.
if you are starting this process, there are so many expenses up front before you ever even talk to a lender. You have already looked at house plans. Maybe you've already taken the point of meeting with an architect and having drawings drawn up. All of those expenses are part of the overall cost to build. And we want to make sure that when we see a cost breakdown, that we're representing all of those costs.
Right.
And so you want to make sure that you include those. And if you want to be reimbursed for those, say you have the land and you've bought the land and you've had it for quite some time, and you want your land to be your full investment into it, and maybe some of the investment is going to come back to you, some of the expenses are going to come back to you. We'll work with that.
Yeah.
We'll work with you in those scenarios. And that kind of gets into the weeds a little bit and the details a little bit. But again, I'm going to tell you, just if you do have questions, just make sure and reach out, because the unique thing about construction loans is every single one is unique. Every single one.
Right,
is unique.
right.
So.
Now we kind of blazed over two-time close and what that means. We talked about the one time, again, is you're closing your long-term and your construction loan all at the same time. But on a two-time close, that's a little different. You're only going to do your construction loan, that's it. And then after the construction loan's done, we're going to then approve you and get your long-term financing. We're going to look at, would you qualify at the time we close a construction loan, but we're not going to close that long-term. So a lot of people say, well, if I'm doing a two-time close, because I have to do that, could I can I lock in that long-term rate? And the answer to that, the short answer is no. You can't lock in your rate until you're 60 days within getting that certificate of occupancy from the city. So we'd have to work with you and your builder, figure out about when you're going to close, and then we can work backwards to figure out the 60 days. And then we just keep an eye on rates and make sure you're going to be okay.
So this one makes me really happy. Prepayment penalties. Do we have any prepayment penalties?
Nope, not on any of our loans. So
Nothing.
you never have to worry about that. That's a huge bonus. So don't have to worry about prepayment penalties.
So what happens if we go over budget during the course of construction?
Well, that depends.
We hear this all the time, especially the last 2.5 years.
Now, fortunately, you do have the 10% contingency, but let's assume that you've exhausted that, you've used it all up. Then on a one-time close, unfortunately, you are going to have to come out with that money out of your own pocket. So that's why at the beginning of the loan process, when we're going through this underwriting stage and gathering all the information and having you get your cost to build from your builder and his subcontractors.
And sometimes we sound really tough when it comes through asking those questions. Sometimes those questions are like, are you sure? And wait, you missed this line item. Sometimes we're really picky.
And our underwriting department does a good job of knowing about what costs are, especially in certain areas. They can distinguish between one area and another. And based on what they're seeing, they will say, okay, this looks okay, or this is kind of borderline, or you know what, I got to get more information. This doesn't look right at all. And we go through these steps in the beginning so that you don't have to come with additional money out of your pocket. That's the whole point of us trying to make it work for you in the best way possible, is just so everything runs as smoothly as possible. Now, does that happen every time? No. we went through a horrible stage during COVID where the cost of lumber and construction just skyrocketed. And that was tough. That was tough on people that were doing custom builds. But we definitely, communication is key to us, and we're going to work with you in every situation that's going on.
There may be scenarios where we have to go ahead and pay it from the long-term loan if you've done a two-time close. Even some situations, if you've done a one-time close and you're just not able to make it work and you need more money, we'll roll it to a separate long-term takeout and we'll pay some of those things out of the long-term. We really try and help you through, and that's why we've said communicate, because
Right.
the more that you can let us know. So
The bottom line is we do have a few tricks up our sleeves. We'll use those anytime we need to, but there is potential some issues.
yeah.
FICO scores, minimum FICO scores is 700, but 720 would get you best pricing and above. So not overly horrible. If you're having issues with your credit or you think you're not quite there, we do have some great relationships with some credit counseling companies that can help you. We can do some, what is it called?
Rescoring.
A rescoring through here. So there's a what if scenario we can run. It'll tell us, yeah, if you pay off this and this and this, it'll raise your score to X. And so we can actually work directly with you on things like that. So if you're concerned about that, reach out to us, let us know, and we'll look to see what we can do. And then we hit this already, but extensions, what if we need more time?
You know what, we understand, especially like Jeff said, this past couple of years, we understand that there are always issues that come up, and we are willing to work with you on extensions. Now, you may have to pay a fee for an extension, depending on what the scenario is and everything else. But we will work with you to make sure that we get you through the finish of this construction. So if we need more time, we need more time, and we'll work with you.
Great. Well,
so
here's-
lastly, the biggest thing that, again, remember, every scenario is unique. Construction should say construction equals unique, because every scenario is unique, because every home is unique. And so just make sure that if you do have questions, reach out to us. This 801-223-7640 is a general line. You will be connected to a loan officer that can help answer any questions on your construction loans. Again, my name is Jennifer Young. I'm a sales manager. I cover the northern region.
Jeff Porter. I'm in the central area, and we have teams that we run. So happy to answer any questions that you have, and we do these loans ourselves personally. So if you wanted us to help you, we certainly could do
So
that.
any additional questions?
I don't see any
covered
additional
all?
questions. Yeah, I think we got everything.
Okay.
So thank you for attending. Appreciate you being here. And please reach out to us if you've got any questions.
Hey, enjoy your afternoon.